Well, another Federal Reserve meeting in the books, and what powie wowie.
It's going to be him, but he's a very talented guy.
Yep, we know. Thanks, Trump. Trump just came out of nowhere there. I was just putting down my cup of coffee. But anyway, what Powie Wowie just told us is frankly just bullish the economy. Now, we went into this meeting thinking that Powell was going to give us 25 basis points of cuts, that he would signal QT within 60 days, the end of QT, and that we probably end up seeing 10-year Treasury go up to 4.05%. I even sent trade alerts in the courses around this. And folks, what we got was incredible. We got 4.05 on the 10-year Treasury. We got 25 basis points of cuts. But we even got something a little bit more bullish. We got the vacuum cleaner of money will end on December 1st, and they're going to take extra money that is left over from mortgage maturities on their mortgage bond securities, MBS portfolio, and they're going to buy treasury bills with that, which is not as bullish or stimulative as them going and printing money and buying every duration of treasury bond, but it is a way of them reinvesting money into the economy. So it's what I call in disguise stimulus. So Powell's trying to put on this hard face of going, everything's fine. We haven't seen any real bad news yet, but they're really worried that the labor market could fall off a cliff. They're just not seeing it yet, which is exactly what we expected that the Federal Reserve would talk about. That the Federal Reserve would end up coming out, Powell would end up telling us, hey, we'll end up we're gonna look what we wrote. We literally wrote that he would downplay private credit risks. Guess what he did? We ended up getting a downplay of credit risks. Labor at break evens, he told us the break even rate is basically zero. And what's the labor rate right now at with ADP reads? About 14,000. So that's essentially why we got the 10-year Treasury to 4.05. Not a surprise at all. Now, what did we get from Powell that's broadly bullish for this market? And why did I send out a buy the dip alert in the middle of the presser and in alignment with our plans in the Meet Kevin report? Because, well, frankly, that was broadly bullish, and this is exactly the MO of basically what happens every single Fed meeting. People get nervous before Powell comes out, they get nervous while he's talking, and they get bullish afterwards. That's why I sent the alerts I did, and remember, in case you want those alerts all of the time, get that Meet Kevin membership. All 8 courses, potentially a tax write-off, every trade alert, the top 10 stocks to buy, every alpha report every morning. Use that coupon code Schumer Siesta. It expires tonight. We'll be raising the price.
Coupon linked below.
So, with that said, what did we get specifically out of Powell today? Well, we actually got bingo. Barely. Right at the end, we got bingo. We got inflation outside of tariffs nominal. Yes, we already know that. In fact, he gave us a number. He thinks that inflation is sitting at about 2.3 to 2.4% outside of that one-timed longer-term effect of inflation from tariffs. Once those tariffs feed through, no more tariff inflation. Talks about housing inflation continuing to come down, which is really a bullish anchor for inflation continuing to come down. It's really hard to argue that inflation is going to somehow second wave, and that's why I think over the next 10 years, well, probably 8 years from now, we'll see interest rates come down substantially over time. But no fall off a cliff on the labor market. And this is exactly what we saw in the ADP data that came out on Tuesday. This is why we talked about this. I even sent a special note to course members yesterday. I go, folks, that ADP report is going to have Powell go bullish on the economy today. Because the ADP report told us we're actually probably above break evens. Now, does that mean we might end up seeing the economy fall off a cliff with a labor market that ends up driving substantially more layoffs, like we've seen with the announcements from Hewlett-Packard, Target, Walmart doesn't want to hire, Goldman doesn't want to hire, Amazon's laying off? Of course that could happen. But what did Powell tell us? He told us exactly what we thought he was going to say, that the labor market right now is in balance, and we're just not seeing that weakness show up in the labor market right now via unemployment claims or any kind of weekly data. That's one of the reasons why on our bingo sheet, I literally wrote stabilizing labor. And I wrote it twice over here. Break evens near 0. That was my prediction. That's what he said. We also wrote down stable, no cliff unemployment. We got all of those. We nailed all of those and got bingo across the bottom row there, which was great. Now, we didn't get a direct mention of the beverage curve, but he basically told us as much as what we needed to know regarding the components of it. So broadly, you got a bullish Powell here, an economically bullish Powell, and that's why one of the reasons during the meeting, we briefly saw the market sell off because Powell told us, hey, we don't know if we're going to have to cut in December. This is a way of Powell just being bullish about the market. In fact, right now, we only see a 67.9% chance of a cut in December. That plummeted from 92% chance before the meeting. We had a 92% chance of a rate cut in December before the meeting. That has now collapsed to just 67.9%. Now, he does say this could change, that layoffs are not in the initial claims yet, and they take time to show up, and that we're watching and monitoring these layoffs carefully. But right now, we're somewhere between 3 to 4%. Neutral is somewhere around here. We've already cut 150 basis points. There's no big reason to cut more now. This is why I said short-term bearish on mortgage plays and yields likely to go up after Powell. It's exactly what happened. It was in our playbook with course members in the Me Kevin Alpha report. Now, Jerome Powell goes on to say that interest rates really don't affect data centers. And I hate this phrase, but he says this is different when he gets asked about AI spending today compared to the dot-com bubble. He says that in the dot-com bubble, we were spending money on ideas, and that today we are spending money on corporations with real earnings. And in fairness, if you compare back to Cisco, the earnings of Cisco were absolute trash in the dot-com bubble. And if you look at the earnings of Nvidia with the margins that Nvidia has, it's absolutely mind-blowing how different margins are today at companies like Nvidia compared to Cisco back then. Now, does that mean we're not going to end up seeing a bubble? Not necessarily. At some point, the party will be over. But look at those margins at Nvidia. A true financial analyst will look at these margins and go, holy smokes, that is the largest PP I have seen in my life.
Big PP.
56.4% on a chip designing company and a software company. Nvidia doesn't even make the damn chips. They're just the freaking middleman. They come up with the designs, they send it to Taiwan Semi, and then they sell the chips directly to the end user. It's remarkable, and it's why they have so much freaking profit, and why I've raised my price target for Nvidia for the near term. Now, do I think it's going to keep going for 10 years? No. That's why Nvidia is not on my top 10 stocks to buy for the next 10 years. Do I have 7 figures of Nvidia stock in my personal portfolio? And am I personally jumping up and down about the fact that Nvidia has now crossed $207 per share? It's up another 3% today on a $5 trillion company. Hell yeah, my friends. Hell yeah. And I'll send you trade alerts when and if I finish trimming this puppy or keep trimming it or whatever I want to do with it. You'll get it in the Me Kevin. Now, that said, what else did we get out of Powell? Well, we get, hey, that next cut in December is not a foregone conclusion. It's far from a foregone conclusion. That's what tanked the odds of actually getting another rate cut in December. Now, part of that is because we ended up getting Schmidt suggest that we should not be cutting rates at all. Myron, of course, Myron comes out, Donald Trump's shill bending the knee, although I've started to respect him a little bit. He comes out and says, hey, we need a 50 basis point cut. And so it's no surprise that you end up getting somebody else to counter that. So you get this, hey, we should have 50. You get somebody else going, we should have 0. We get 25. In my opinion, are we going to get 25 in December? Probably. We'll probably get 25 in December. Does Powell want to promise that now? No, of course not. But it's all going to come down to what we see in that weekly unemployment claims data, which right now we're not getting unemployment claims data because the government is shut down. So we'll wait and see when that actually comes up. That's why I say it's a bearish catalyst when the government actually reopens, because you're going to get that flood of data. Instead, you need to start coming to this channel every Tuesday freaking morning now. Why? Because what are you going to get Tuesday morning? Weekly ADP data. If you haven't been paying attention yet to the weekly ADP data, make sure you start paying attention. It comes out Tuesday I also broke down the weekly ADP data in the data tab of the Meet Kevin app. So if you download the Meet Kevin app, you can see this data. I'll post it there pretty regularly. But here, as an example, on Tuesday, I posted the ADP announcement that the Fed was secretly getting this. Then they got rugged, probably because of Trump. Now they're just releasing it to everyone publicly. But anyway, 14,250 jobs. That's technically above the break even that Powell just forecast. So we would need to see a weakness to probably closer to zero to really encourage more cuts. And so that's your forward-looking indicator now. Tuesday jobs data. We got to pay attention to this every Tuesday now. And this is why, if you don't have it yet, download the Meet Kevin app. You get the data tab and daily wealth for free. Alpha Report and Stocks, that's obviously, for course members. That's, by the way, the same app. We're going to be building in the Reinvest AI in that same app, which will be really cool. And we'll probably rebrand it all over time, Reinvest. You can invest in my startup, our Reinvest AI product, if you want. You could learn more by going to reinvest.co or househack.com. It's the same company. HouseHack owns all of the AI technology. So if you're an investor in HouseHack, you're already in on this. You can always invest more if you wanted to. Go check out the offering circular. Go read about what we're doing with AI. You could read about our renovations. You could look at our real estate, the actual asset-backed real estate that we have. And then you could look at our artificial intelligence plans and our timeframes for this app as well, if you want to diversify into AI. I personally think you're buying in at a real estate valuation, because that's when we got the valuation done for the company, and that's what we're raising on. I'm buying more stock myself in it because I'm so bullish on it. But then again, I'm a biased CEO. There's risk with every investment. So continuing on, other notes that we have in the Meet Kevin app. Our tools support demand. It takes a while for tariffs to hit consumers. We have, once tariffs are in, they're baked in. We go back to 2% inflation. Consumers don't care. This still frustrates people. This is basically a way of saying that most people don't understand how inflation actually works. Prices feel very high, but inflation's actually doing really well, which is why the Federal Reserve can cut rates in favor of the labor market. Somebody just donated here in the chat to say there's a rumor Wells Fargo is going to lay off 20 to 40,000 workers. You have to remember, the biggest risk to this economy is that we do get a real sharp increase in layoffs that end up leading to a surge in unemployment claims and a true normalization of the Beveridge curve. Because if you get that, that's when you end up in an unemployment recession. That is the big risk. This is why I'm bullish on the market right now through government reopening. And I really hope we don't get a lot of layoffs between now and then, because once we start getting that unemployment claims data, things could really rapidly shift. I think a really big red flag for you should frankly be Fiserv. Fiserv is, in my opinion, a really big indicator of not just potentially false promises from the prior executive leadership, but also a sign of the consumer, right? The fact is that Fiserv processes upwards of 25,000 transactions per second. They are part of the financial plumbing of the United States banking sector. And for them to be plummeting, especially when they have high exposure to e-commerce, restaurants, and retail sales, is a sign that there is some weakening happening amongst the consumer. So it's no surprise you're seeing consumer-led companies sell off today, whether it's the Cheesecake Factory, other restaurants. Cheesecake's down 8% today. Macy's negative, Best Buy negative, Six Flags is down 9%. You could see the two-tiered nature of our economy literally in stock prices. Look at Six Flags down 9%, Dave & Buster's down 5%, Restoration Hardware down 4%, yet Nvidia up 3.4%. You see the two-tiered nature of the economy here. And if we continue to get these layoffs, we will have an unemployment crisis, and it will take a decade to get back. Is that going to happen tomorrow? Probably not. And that's what the Fed is reacting to right now. They're saying, look, we're going to insurance cut right now, but are we really worried about the employment market falling off a cliff right now? No, we're not. Okay, maybe that'll end up being a mistake. Are they worried about private credit? Well, maybe they should be, because the International Monetary Fund basically says we're in a freaking bubble. The International Monetary Fund says that stocks are at least 10% overvalued right now. Not as bad as it was during the dot-com bubble, where we had 20% level of overvaluedness. But the IMF is literally worrying about the amount of exposure that our big banks have right now to non-financial banks or non-bank financial institutions. And that if collateral values fall in private credit, hedge fund exposure, private credit exposure, and some of these subprime lending things like what we saw with First Brands and Tricolor, we could end up seeing bank solvency ratios get substantially hit and massive adverse scenarios to the US banking system, especially since 90% of all lending to these non-bank financial institutions is conducted by not small banks, folks, large banks. That's a really big red flag. So there are serious risks. This is very important to understand. There are real risks. Massive risks in labor, massive risks in private credit. The only way we can really get accelerating off the ground here and sort of have that bulked landing, if you will, where like you're coming in to land the plane and then you're like, nope, just kidding. We're going to go full throttle and we're going to go up again. The only way you could get that is the labor market going up again. Even Powell says that. He says, look, the best thing we could do right now is support the labor market so we can actually stick that soft landing and come up off that ground. To me, I love the plane analogy. I literally have a video of me pulling off a plane analogy, just like what I've just described, in a $13 million jet. In a $13 million jet, I break out of the clouds, come in for a landing in Santa Barbara, and you see me throw the throttle full force in. This is a perfect analogy. Powell says we are flying in the fog right now. He uses those words and he says you slow down when you're in the fog. So this is me flying a jet in the fog. And what we're hoping is that we can come out of that damn fog and we could see beautiful blue skies ahead. That's the hope. Are there problems? Private credit, weak labor. Absolutely there are problems. But watch my hand. You're going to see my hand go full throttle. That's juicing rates. You gas the economy. You juice rates. You go full throttle right before you land and hit the ground, and you take off again, baby. That's called a bulk landing. You don't want to land this plane. You want to keep flying the jet. That's what you want. You got a jet engine of the American economy. You don't want to bet against America. You want to go full throttle on this puppy, and you don't want to crash. So let's see it here, baby. Runway 7 coming into Santa Barbara. Give me that full throttle, baby. Juice me. Oh, yeah, look at that hand go forward. And then what happens? Before your wheels touch the ground, you start flying again. This is literally the perfect analogy for our economy. We do not want to smack that runway. We want to go flying. Look how beautiful this is. That's what's on the other end of this. If we can get through this disaster, this like potential private credit risk or labor risk, we could go flying again. Look, I'm even overspeeding my flaps in this example here because we're just gonna fly hot, baby. And that's part of what we're seeing with real GDP estimates. I mean, look at the Atlanta Fed. This is the first time over the last month that we are actually starting to see the blue chip consensus for GDP forecasts climbing. The blue chip consensus has always been way below the Atlanta Fed GDP Now estimate, and it's now starting to climb. And so as long as we can climb out without smacking into the ground by hitting some kind of unemployment recession, we could be Gucci here. And for the near term, it's bullish. So I'm optimistic. I'm hopeful. I'm not like, oh, let's go all in on margin and, lever up. I'm cautious, but I'm cautiously optimistic. And I just hope we don't fall off a cliff with these layoffs. The risk is when some companies start laying off, you get the game theory, right? We talked about this the other day. You get game theoryism that happens with layoffs, where if one company lays off to pump their margins, other companies would be dumb not to lay off. And the problem is when everybody starts laying off, that's when you end up with the pooper dupers, because then the broad economy ends up suffering because consumers don't have money to spend anymore. That's the big problem and big risk factor and big danger. So with all of that said, make sure to go check out Reinvest. Check out our AI if you want. You can learn more about it all over at reinvest.co or househack.com. It's the same company. We've had the best fundraise month so far this year, I believe. We're well over 7 figures now for fundraising, which is a fantastic month for Househack and Reinvest here. And then, of course, check out the Meet Kevin Alpha Report. I think we actually might be having our best month on the Meet Kevin Alpha Report as well, because people are loving what we're doing in the Alpha Report. They're loving the buy-sell alerts. They're loving the setups in the morning for trading, and what to look for, even with fundamental analysis. Not just traders in there, but people who are like, Kevin, I want deep dive fundamentals. I don't want to sit here and do the fundamentals myself. I want somebody to just tell it to me like it is. That's what you get at meetkevin.com. So go check it out. Use that coupon code SchumerSiesta.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.